This is the Investor Mindset Podcast. Talk to me a little bit about what is one of the biggest challenges that you guys faced. One of the things that maybe happened that was unexpected when operating one of these small or large properties, and kind of talk to us a little bit, about how you guys handled that.
So I'd say one of the bigger challenges, which is obviously understandable, is the trust and the relationship that we have with our external or our third-party property management companies. I mean, as you know, they'll make or break your entire deal. Now, ultimately, it falls on us as the asset managers and the sponsors and the people driving the bus of the investment. But that has been the biggest learning curve, if you will, with our investments. To give you an example, we did buy, I won't name names or even locations necessarily, but we had a property management company that looked great on paper. We interviewed them. We had great conversations. Their knowledge base seemed great. We even talked to a few references. And then we learned about 6 months after closing on a deal that a lot of that was inflated. A lot of that was unfortunately not true. And so, the hard part for us is explaining to the investors why a certain investment isn't necessarily where it's at right this moment. Luckily, we caught it in the first 4 to 6 months, but and then the transition in the first 4 or 6 months to a brand new property management on a big deal. And that, you asked me about an example. That's certainly not a position that we want to be in. By the way, we need to put our big boy pants on and explain to the investors why this is going on. We had kind of built into the entire projection a first year that would not be that successful certainly as the projection is concerned, but not like extremely large return, because oftentimes, whether there's a great property management company or not, you're taking over a property that's going to see a little more vacancy, a little more work needed up that first year, because of the meat left on the bone, if you will. But it wasn't to where we wanted it to be. And having that conversation with the investors and let them know we're taking a change of direction, hiring a new property management company. That just happened 4 or 5 months ago. And they were able to raise the occupancy within 4 or 5 months from the 70s into the 90s. Now, we expected 70s. We expected an average first year of in the 80s because of the large, the amount of work that's in the property. So we always expected in the 80s on an average. So the fact that we're already in the 90s, we're ahead of it. But our first 6 months, we were behind it. And so, you asked about an example of where it didn't necessarily go our way. It's going to end up exactly where we wanted to, if not better. But those are the things you got to kind of roll with. And I think it helps that we have the background in property management to know what to expect and kind of make that quick transition.
And had you not made that change from an asset management level perspective, if you had not had that experience to know that you need to make that change, be in a pretty rough position for the investors long-term. You've got to make that decision quickly. You've got to give them enough run time to see if they're going to actually do what they say they're going to do. But at the end of the day, you've got to make that tough call.
Right. It was the best call we could have made.
So one of the things that I really appreciate about your group is that you've had experience working not only in different states, but different class levels of property, A, B, C, and even D class, even though, Von Finch, we stay away from D for some different reasons, but there's some opportunity that can be huge when you're working with a really good operator. So talk to us a little bit about how you've gone through that progression of the different types of properties that you take down and where you're doing it.
I mean, we're the same, right? We're not really interested in D-class properties. We have purchased them before and we've been relatively successful, but those mainly the beginning of our career. And it's also because we didn't know what we didn't know. Now, I think that's the same thing as saying that we got our hands dirty. The fact that I was working on single family homes myself every weekend and some weeknights let me appreciate what to expect out of somebody who's doing that. And same can be said about if you can turn successfully a D-class into a mid to high C, your ability to take a high B into an A is much easier, but certainly you've dealt with a number of situations. So, and that's what I like about what we've done, right? 7 different states, all different class levels. It just helps us become better. We're more well-rounded and we know what to expect from different asset classes.
Yeah. I think one of the things that's interesting is what you hear in this industry is a lot of people start out working in that C class, in that low B, that is where a lot of folks start, because that's where you have access to buy those deals. They're less appealing, but there's usually a lot more meat on the bone. There's a lot more opportunity to create value if you are very hands-on, if you have the ability to execute very well. So it really goes to show and goes to say a lot about your guys' experience in doing that and having success with it. But it's easier to take something from a B to an A, right? Because you're dealing with a tenant class that, one, wants to pay their bills, and two, that is just a little bit easier of a building, newer of a building, typically to work with. So I can definitely understand why there's been that transition.
Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.